in Kenya and is also concurrently floated in Uganda because of that component of cross-listing. The price of the bond is, say, 1,000 here, 1,000 shillings, and the corresponding bond being floated in Kenya is also floated in Uganda at a price that is, in terms of Kenyan shillings, at 950 shillings there. What happens is that the Ugandans probably will identify that opportunity and will be able to invest in that fixed income instrument there. As well, you will find that Kenyans will be able to identify that opportunity because it is the same instrument. You buy low securities and you try and sell them at a higher price. So you'll see capital flows moving from Kenya to Uganda to purchase that bond. When you find too much money chasing too few goods, you'll tend to find that the price will tend to shoot up like that. And that upward pressure exerted onto this 950 will lead to an increase in the price to about 1,000, which is the equilibrium price there. Now, those investors in Uganda and in Kenya who had invested in that instrument will want to, at 950, will want to sell it at the higher price of 1,000. And if they're successful in selling that security in another jurisdiction, say, for example, if they're selling it back to Kenyans or they're selling it to individuals within Uganda at 1,000, they will earn what we call riskless arbitrage profit. They will be able to earn profit of 50 shillings because it's difference between the 1,000 and the 950. You're saying they'll earn that riskless profit. That riskless profit that is earned for a security that has been issued in two different jurisdictions is what we're saying is arbitrage, or some individuals prefer to pronounce it as arbitrage. It depends on how you've actually been taught. Now, that is arbitrage. You try to earn riskless arbitrage profit. Now, using that instrument, that is also a goal for alternative investments or alternative investment analysts and investors as well, to try and earn riskless profit. That is arbitrage. Now, I'll also be able to try and explain return enhancement. Return enhancement refers to earning a return earning a return beyond the initial purchase price there. So when included in a portfolio, if you try and include alternative investments, so here we have equities, here we have bonds, here probably we have investments in derivatives like that. The moment you include alternative investments in the portfolio, it has the tendency of enhancing the returns over a period of time. Generally, alternative investments have got or tend to produce some returns depending on the type of alternative investments. We are saying that there are some investments which are very risky and they have got that erratic movement in terms of the price differentials there in the market. So we are saying that investing, say, for example, in real estate tends to have some positive returns over a long period of time, and including real assets or real estate in the portfolio, it tends to enhance the value of the portfolio there. We are saying diversification refers to the spreading of risk distribution of risk by investing in uncorrelated securities. That's what you're saying is diversification. It refers to the spreading of risk or distribution of risk by investing in uncorrelated securities. There. That is what you're saying is diversification. I had drawn a graph. I can be able to also redraw that graph again over here that demonstrates the impact or the implication of including alternative investments in a portfolio there. So we have risk there, and we have number of investments there. So each investment has got a risk inherent in it. This is the non-diversifiable risk, non-diversifiable risk there, and this is the diversifiable risk. This part here is the diversifiable risk. Diversifier risk there. So we are saying that if you invest in uncorrelated securities, alternative investments tend to be very good diversifiers or spreaders of risk there. Now this brings us to the end of this topic. However, I have a series of questions that I want you to go and do so that you can be able to reinforce your decisions, your understanding, sorry. The question is as follows. November 2017, question 1A reads as follows. Explain 4 return characteristics that distinguish alternative investments from traditional investments. We've looked at that. Then the second question I want you to also go and do research on, or go and read on, is May 2017 question 1A, which reads as follows. Explain how the following primary structures distinguish alternative investments from other traditional investments. Number 1 is regulatory structure. Number 2, trading structures. Number 3, compensation structures. Number 4, security structures and institutional structures there. Thank you for being with me for this first topic. We hope that you'll be able to join us in our next lesson, where we will be looking at the environment of alternative investments. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.